right, since we were on the topic earlier of dumpster fires, let's take a look at Target. The stock got downgraded to underperform today at Bank of America. Stock that's down 24% year to date. They are losing out, according to this note from Bank of America. Brenda, you own it. You still own it, right? You do? Okay. Take me through this feeling of why you still own it.
Yep. So we bought it in March of this year after it was down a significant amount already, knowing that this is a turnaround story. And I think this past quarter was, particularly tough when you have an Amazon Prime Day that lasts for 4 days, that sort of thing. Definitely more competition in the market. But we do think there is an opportunity here with newness to turn the concept around. So we're sticking with it for now. The stock is inexpensive. Expectations are very low going into this quarter. Company reports next Wednesday. So we're going to stick with it.
Okay. Salesforce. Throw that in the mix. It actually got upgraded today to neutral from underperformed D.A. Davidson. The commentary here, really interesting. Over the past few months, investor sentiment for Salesforce has declined sharply, which we believe is appropriate. There will be another round of investor activism and increased pressure on management to refocus on growth of the core business, additional margin expansion, and hold off on dilutive M&A. So Starboard has increased their position here. Rob, you own the stock.
We do.
What's your feeling here?
Listen, we bought it a while ago. We've been patient with stocks like this and Adobe. This is a stock that dominates this space, but then there's no doubt they're a company that's going to have to deal with macro headwinds and restrained IT spend. And so hopefully we think that they're going to be the price represents an attractive enough price.
Yeah, I don't feel like this stock, I'm sorry to interrupt you, but I don't feel like this stock has done what it's done in any way because of either macro headwinds or IT spend. It's been about AI. The perception that it's losing out in AI.
Yeah, no question.
As has Adobe. So let's be real. Let's get real.
But when you have companies like this that are ingrained in the fabric of corporate infrastructure, I know we use it. It's pretty important.
I know. Josh Brown has talked about they use it too.
It'd be a pretty paramount shift to move away. So when they adopt, when they're able to figure it out, I think there's probably asymmetric upside at that point, which is one of the reasons why we've been patient. My point is I don't think that time has arrived, given that we're walking into some restrained IT spend. So pay attention to the name. They're everywhere. They're dominant. And they're going to figure it out. It's only a matter of when. They're not going to get eaten up.
How about, you want to say something?
Yeah, I'll just say that I think with Salesforce in particular, if you look at the type of data that companies have in Salesforce, it's very important data. And it's data that would be incredibly useful to use for AI for many companies. So I think that they're starting to get traction with Agentforce. I think it's there. But to your earlier point, Scott, I think they've made a ton of acquisitions. They need to regroup, refocus on profit margins. And that's a big part of the story here, and I think a real reason why it's underperformed. But I think the data they have is very important and sticky.
Let's hit Cisco. Earnings this week. Stock got downgraded today to hold from buy. Target 69, just down a few bucks. $4 from HSBC. Jenny, you own the stock.
Yeah. So the reason they downgraded it was because they said that they didn't see any material tailwinds evolving, and we disagree with that. I think. They just delivered 14% earnings growth, 7.5% revenue growth. And I think this is really about managing expectations and having the right expectations for the right company. So the more technology that's out there, the more sophisticated technology that's out there, it's just good for Cisco. It'll help them drive consistent revenue growth. But it's not suddenly a rocket ship of AI that's going to drive their business. And so maybe there was a little bit of, expectation that they were going to ride the AI boom in a really aggressive way. They're not. So what you have is a stock that trades at 17 times earnings. It's a huge discount to the tech sector, 6.6% free cash flow yield, and very predictable mid to high single-digit earnings growth ahead. That works for us. We'd be a buyer here still.